Okay, good day, everyone. This is Jim Kinney, and we are going to get into quite a bit of material here today. Prior to getting into the material, though, I did want to get a disclosure, which we always start out with each and every webinar, and it is the CFTC risk disclosure statement, which you can see on your screen there. And of course, this one statement is not comprehensive on all the different things you need to know, uses and risks of the different investments out there. But this is a start. Some of the parts in the statement include that this type of trading, futures and options, is not suitable for all investors. And there is a risk of loss, which in some cases can be substantial, no matter who is managing your money. But the risk of loss can be substantial in the futures and options arena. Also, there are disclosure documents which are available on the managers that I'm going to discuss later in the broadcast, which give obviously a much more comprehensive disclosure on the methodologies, the risks, the fees, the incentives, the backgrounds of each CTA. And of course, we must remember this, and I'll be repeating it throughout the broadcast, that past performance is not necessarily indicative of future results. I will be talking about performance numbers, but they are historical. They've already occurred. And so obviously, past performance is not necessarily indicative of future results. You must realize that as you listen to everything. Okay. All right. With regards to some of you who are attending here today, in addition to the managed futures, you may have interest in other markets, or you might have interest in the managed futures and other markets. At any rate, some of the other markets that there are contracts and options available on, I'm going to ask 3 polling questions now. And basically, these are kind of yes or no answers, or if you don't have an answer, yes or no, just don't do anything. But the 3 questions start out with, are you interested in short-term, out-of-the-money S&P 500 option writing? And that, would be I am interested, I'm not interested, or I'm not sure. Second question is, are you interested in options and futures on different markets? In other words, strategies of contracts and options on things like the stock market indexes. The indexes could be S&P, they could be the Russell, they could be the NASDAQ, they could be whatever stock index you choose. Or they could also be in the area of interest rates, the 10-year note, the 30-year bond, euro dollars, all different types of contracts on interest rates. Another might be the U.S. dollar, either on foreign currency or on the U.S. dollar index. And another area that interest may lie would be in the price of energy, oil, crude oil, unleaded gas, natural gas, and heating oil. And then, of course, you turn towards the metal arena, where some people have interest in gold or silver or copper. And then, of course, you've got your agricultural sector, which would include, among other things, your corn, wheat, and soybeans. So there are contracts available. There's options available. And I'm going to just here give you a quick number to write down that if after the broadcast you had interest in getting more information on that area. The phone number to call is 702-873-5707. Repeating, 702-873-5707. And we'll be glad to get information sent along on your areas of interest, the uses and the risks of the contracts and options you're considering. And then, of course, you could either be self-directed, or possibly you could discuss the different strategies that you might be interested in. Okay. All right. Getting to the main course here today, I'd like to introduce myself. I'm Jim Kinney, and I am the branch manager here for the High Ridge Futures. Now, HRF is a introducing broker, and HRF has a clearing relationship with ADM Investor Services, which I'll discuss further at the end of the webinar. But they are a firm that has been in business for better than 50 years. Quick background on myself. I'm a graduate of Boston College, and I have been registered with the NFA for over 30 years. I've passed examinations during my career, including Series 3 and also Series 30 for branch manager. So with my background and experience, I do feel that I am qualified to explain the uses and the risks of managed futures and how they may or may not fit into your portfolio. And I'm going to do that starting right now. Okay. All right. Showing some slides here. And the slides are really going to be comparative studies using indexes as a comparative illustration. Now, on the stock index, it could be the S&P 500, it could be the Dow Jones, whatever the comparison is. And on the CTA side of the comparison, there'll be indexes of a basket of managed futures trading advisors. So they do not represent the entire universe of advisors. Neither do the stock indexes represent the universe of all stocks. So bear that in mind. The comparisons will have some limitations to them, and be aware of that. Okay, now here's some questions, and we're going to have graphs, and I'm going to go through this area. But remember, at the end of the broadcast, I will be going over advisors that I have zeroed in on that I am suggesting for people that are suitable and have the risk tolerance for this type of activity that they would consider. Okay, so again, the thought-provoking questions. There's going to be a comparative information on things like the 5 worst period of declines for stocks since 1987 and how managed futures relate. With regards to the next area will be 15 worst quarters for stocks over the last 25 years and how managed futures compared. The next one is most critical events over the last 35 years and how the managed futures performed vis-a-vis the stocks. Then, of course, will be the very worst stock market declines in history since 1987. And again, how managed futures compared during that situation. Also, the past 25 years, a portfolio diversified with 20% into managed futures and how the performance was against those that just had the stocks and bonds only. And then finally, over the past 35 years, managed futures, how they have done against stocks and also on international stocks. So there's quite a bit to learn here. Before we get started, though, one thing that people find a little bit surprising sometimes is the money flow into the asset class of managed futures. So we've got some data on that I'm going to share with you right now. Over the past 15 years, total assets invested in managed futures have grown by 771%. That's more than it took to grow in the previous 20 years in this asset class, reaching a major milestone at the end of the first quarter of 2015. Now, according to the Barclay Hedge, which is one of the oldest and most respected providers of the alternative investment data, out of the $1.78 trillion invested in alternative investment strategies, the managed futures surpassed all other investment strategies based on assets under management. Sometimes it's quoted as AUM. So the managed future, as far as an asset class, has attracted money. And right now I'm going to show you, well, I'm going to explain it first, and then I'll show you a graph on it. A managed future account is this. You have an account where a registered commodity trading advisor, they call them a CTA, is given responsibility to make all the trading decisions. Now, this authority is delegated by the account holder to the CTA through a limited power of attorney, and that can be withdrawn at any time. Now, these CTAs, these trading advisors, right, they are registered with the CFTC, an agency of the federal government, and are members of the NFA, which is a self-regulatory organization authorized by Congress in 1982. So these CTAs are professional money managers, and they manage an investor's assets using investments in the commodity markets, and of course, the stock market index would be included in that. Similar to the way the stock mutual fund manager would invest his client's assets in a variety of different stocks. So there are many managers. They do different strategies, and that's why they have disclosure documents to let you understand that. Now, some people who feel it is right for them and are interested in diversifying a part of their portfolio, they can use a variety of different accounts, including a qualified retirement plan like the IRA, a trust, or a pension. So the asset class is being used in a wide variety of type accounts. Okay, there's the graph I was referring to, which is the graph that goes over the growth of the managed futures industry. And that graph really puts a lot in perspective, huh? Around 2000, a little bit after when we had that dot-com crash, it seemed like that's when people started to go into this asset class. And obviously during the 10-year period of 2000 to 2010, and obviously into 2015, there has been a acceleration of assets going into this class. And so there you go, 771% growth based on this information here. And that is obviously a substantial increase in participation in the asset class. Having said that, of course, it's not right for everybody, but to find out if it's right for you, we're going to try to give you more information on it. Okay. All right. The next slide here is the growth, which we already talked about. 1980, there was less than $1 billion in managed futures. 2000, it jumped up to 37 billion. So that was a pretty good jump in 20 years. But obviously, since 2000, like I said, after the dot-com bust, you jumped, to 330 billion. So that's quite an inflow of assets into this class, and it makes it interesting to take a look at from that perspective. Okay, next slide I'm going to show you is these are the comparative studies. Now remember, to be specific to any manager you would hire. So from that standpoint, there's not a lot of weight to this, but it is for illustrative purposes giving you an idea of the comparison between the CTA indexes and the S&P stock index. So right here, they're going to be talking about during the S&P's 5 worst drawdowns. And as you can see, the BTOP, and that's the Barclay Top 50, that is an index of the largest trading advisor programs as measured under assets under management versus the S&P 500. The comparison is constructive towards the BTOP 50. Next one is going to be performance of the index versus during the 15 worst quarters for the S&P 500. Again, there's your numbers. S&P 500 total return index against the Barclay Top 50 index. And you can see the differential there is quite favorable. Again, these are historical numbers. And again, past performance is not necessarily indicative of future results. And again, these are indexes, so your specific results will more than likely vary. Okay, now you've got the CTA returns during periods when the S&P 500 lost more than 10% in a quarter, going back to 1990. Again, here you're looking at the Autumn Gold CTA index. So they switched indexes on us here. They're now using Autumn Gold CTA index. And again, versus the stock index, the S&P 500 total return index, you can see again the comparison is favorable when you compare index to index. Okay, the next one here I'm looking at is on the return during critical events. And as you can see, some of the critical events include, going back to 1980, it included Black Monday, 1987, a horrific day in the market. Then long-term capital management, they got in big trouble back in 98. And then, of course, we had the horrific 9/11 and the dot-com situation, of course. Then you had subprime mortgage crisis in 08. And then you had the downgrading of the U.S. debt in 2011. And obviously, that during that period, the comparative study here between the Barclay CTA index and the Dow Jones. See, they switched over to the Dow Jones here. You can see there that the comparison during these critical events is also favorable on index versus index on the managed futures. Okay, next chart is going to be managed futures performance during the worst stock market declines in history. And there they are right in front of you there. Lots of different, shall we say, bad times that have occurred. But as you can see, the S&P 500 index, in comparison to the Barclay Top 50, the numbers are favorable towards the Barclay Top 50 index. Again, these are past performance, so not necessarily indicative of future results. And again, these are only talking about these indexes, not any specific advisor or not any specific stock. Okay. Next one here is the effect of allocating 20% using the index as a comparison of a traditional stock bond portfolio and then throwing in managed futures with a 20% allocation. You can see here, based on the index to index or the index comparison, where you have just stocks and bonds versus the situation of adding a allocation or asset class such as managed futures with an index being used as comparative study here, that the results had improved significantly when diversifying into the managed future using the indexes as an illustration. Okay, there's a 35-year study comparing managed futures to stocks and international stocks. And again, they're using the indexes again. And in this case, they're using the Barclays CTA index, representative, again, of commodity trading advisors. There were currently 535 programs in the calculation. And obviously, there's a lot more than that out there in the universe. And they are comparing it to the Dow Jones, which obviously there's a lot more stocks in the world than just the Dow Jones. So there are limitations on these comparative studies, but for illustrative purposes only, you get a little bit of an idea if you go index to index, you know, that there is some favorable activity on the managed futures side. Okay, and then managed futures risk reduction and performance enhancement. Here's the idea behind that. And of course, there's theory to it and there's reality, and they don't always match. So let's be clear on that. The idea or the concept or the goal or the objective, which there's no assurance you're going to meet, is that because managed futures or the manager you work with is not in stocks, individual issues like the S&P 500 index, or in bonds, that the correlation may not be high. And ergo, you have a non-correlated situation of diversification there. Now, that's the objective, that's the goal, that's the thought. And of course, like I say, there's no assurance that that will be the actual fact, but that's the idea. Now, if that were the case, and that's the way it panned out, then obviously you could, if you got good performance in the managed futures and you didn't get such good performance in stocks, obviously that's the way you might be able to enhance your performance. Obviously the converse could happen as well. And then of course you've also got a situation where if your stocks and bonds are getting nailed and the managed futures are hanging in there, it would reduce the risk of the overall portfolio. You know, there have been studies on this. One was a landmark study by Dr. John Lintner of the Harvard University, and he studied the idea using indexes, I would believe, and he did think that the results were that with the managed futures account, it could change the performance and the risk situation on your portfolio. That's the concept. Okay, amateurs versus professionals. This is where I'm going to get into exactly what's available out there that I'm targeting or that I am zeroed in on. Now, again, many people believe that using a CTA in this arena is the better way to go. That's what some people believe. But there are some individual investors, and many of you are out there now, who believe that they have the know-how, the time, the access to information, the necessary temperament, and all the other stuff to be a highly successful person directing your own investing, including futures investing. Now, unfortunately, from the CME group, they did a study, and that's not the way the numbers panned out. So in their study, it indicated that somewhere between 2 out of 3 and 9 out of 10 lose money. However, some CTAs have been shown to achieve consistent returns even in volatile markets. No assurance on that, no guarantee, but that's the way some of the study that they did panned out. So again, why would you want to consider diversifying with the managed futures? There's many reasons. One reason would be that you're looking to diversify your portfolio so that if the stock market were going into a different environment, or the bond market, which has been choppy a bit, got into a bad environment, you'd have another asset class in there diversifying your risk. The other reason is you might see an advisor who you think has a good methodology, and you believe the methodology is something that has a long-term benefit to it, and you would like to diversify with that manager. Well, there are many managers out there, and HRF has many managers available on the website, and their disclosure statements are available as well. I've zeroed in on 3 of the advisors on their list. The first one is called the White River Group. And in the White River Group, they've got 2 different programs. They are both run by the gentleman named Andreas Diesbacher. And the first one is called, and it's the original, it's called the Stock Index Option Writing Strategy. And the program started in November of 2008. Now, there's a tear sheet that's available, and of course, the disclosure document as well. But what I am trying to do now is just briefly, and in this forum, you know, everything is not going to be exhaustive as far as the information that's available, the risk disclosures that must be given, and all the other details. But I am going to be briefly talking over some things that I'm taking off of the tear sheet, which is a performance sheet and a historical sheet. And again, right up front, past performance is not necessarily indicative of future results. And that is something I'm going to repeat a few more times so it's clear as a bell. Now, having said that, the original Stock Index Option Writing Program, it has been around, like I say, since November 2008. The total return since inception is just a shade under 160%, which it's at 159.18 through the end of last month. So through Q1, that's been the cumulative return since inception. Now, the compounded rate of return, compounded annual return, just a shade under 12% compounded annual return at 1198. And then, of course, the winning months versus losing months. Out of 101 months since November 2008, 82 months have been profitable, and only 19 months have not been. So that is a very attractive winning months versus losing months. Again, past performance is not necessarily indicative of future results, but I think that's a fairly reasonable history to at least be proud of. With regards to the way some people gauge, or shall they quantify the risk in these programs. Some people use the Sharpe, for more sophisticated people out there, some people use the Sharpe ratio. Sharpe ratio on the Stock Index Option Writing Strategy program is for 3 years is 0.42, cumulative 1.11. And the Sterling ratio is 0.31, and of course that's also the cumulative as well. The Barclay ratio, 3 years, is 0.36, and the cumulative is 1.35. Efficiency index 0.43, cumulative 1.12. Now, that is the brief discussion of the Stock Index Option Writing Program. Back in 2014, Mr. Diesbacher set up a second program, and he tweaked the original program with a little bit of a different angle. Now, the different angle comes from, and among other things that he's done, but a couple of things had to do with the amount of time that he would get involved with a contract, you know, trading contracts with a different time horizon on it before expiration. And then the other factor was the striking price, and then, of course, changing the number on that as far as selection. Now, since that started in November 2014, the total return since inception, going through the first quarter of this year, was 32.83%. So the compounded annual return there is a bit higher than the other program at 12.47%. Now, the winning months versus losing months is obviously a very attractive thing here. The winning months, out of 29 months of this program, 28 months have been profitable. Again, past performance, not necessarily indicative of future results, but that's an impressive history, and that is a very interesting thing to look into further. Again, the more sophisticated analysis of the risk-reward ratios, you got the Sterling ratio 3-year is 1.50, cumulative 1.50. You've got the Barclay at 198, cumulative the same, 198, and efficiency index the same, 153 and 153. Now, in addition to the strategies that he's working with, generally it's with the E-mini S&P, but obviously in the disclosure statement, it'll indicate what his parameters are. His compensation is interesting as well. And why is it interesting? Because part of his compensation is an incentive where he is linked with the incentive to the growth of the account on a net basis. So he gets a percentage of the profit on a net basis each month, and if there's a loss, there is a suspension of the incentive until the loss is made up. I find that very, very interesting, and in my view, in my opinion, attractive. So there is a incentive to keep the accounts growing, and if they do not grow, there is a suspension of that incentive until the loss is made up. So again, information is available, and after the broadcast, I am going to be giving you my name again and my phone number, and I'd be more than happy to get you more complete details on this advisor, and then you can see if this might be right for you and if it might be right for part of your portfolio. The second advisor that I have zeroed in on is named Pacific Front Capital. Now, different to Mr. Diesbacher on many fronts, one glaring differential is the length of the track record. Now, the track record for this particular trading advisor goes back to last year. But last year was quite a start for the advisor. And so for some people looking for an aggressive return, looking into this advisor might be something you'd want to do. Now, basically, the Pacific Front is utilizing proprietary models, among other things, to generate trade ideas for the relatively short term. Now, last year, they have a performance sheet. And as I look at it here, I'll give you some different numbers off of it. And again, I'm not giving every number off the tear sheet, nor did I do it on the other one. That's why you need to get more complete information on this. But I'll give you some things that I'm looking at here. With regards to the worst monthly drawdown, 9.58%. Worst peak to valley drawdown, again, 9.58%. That's the drawdown on a peak to valley, and also on the worst monthly drawdown. Now, the average monthly return, 10.28%. And the cumulative return for the year 2016 was positive, 128.45%. Now, again, past performance, not necessarily indicative of future results, but this would be somebody to look into if you're looking for an aggressive return using a manager who, again, has an incentive on getting the accounts to grow. Because, again, he does participate in the upside on the account with the incentive of profit. Now, if there is a loss, again, that incentive is suspended until the loss is made. And these are net profits. And so basically, I find that to be an attractive feature of the CTAs. Again, you need to get more complete information. If this is something that is interesting to you, I'll give you a number at the end of the broadcast here, and I'll be more than happy to get it out to you. But those are two gentlemen right off the bat, the Pacific Front Capital, and also the White River Group and Mr. Andreas Diesbacher. Finally, the third advisor that I've zeroed in on is for QEP investors only. So this is pretty much where I have to stop talking about it as far as any type of information, other than that it is available to QEP investors. Now, what's QEP investor mean? It basically means qualified eligible persons. And so again, I am precluded from getting into specifics on the manager, but rest assured I would not be mentioning it as on my radar if I didn't find it, in my view, in my opinion, to be a potentially attractive thing. If you are, or you'd like to find out if you are a qualified eligible person, again, the number I'll be giving you momentarily will be the way that you can get a hold of me. Going to the next slide here, because those are the three advisors I wanted you to be aware of. The next thing here is I'm going to get into is hold on. Oh, tax benefits. Okay, we just came off tax time, so not a bad time to talk about it. Question: are there any tax benefits to investing in managed futures? The answer: yes. According to the Tax Act of 1981, short-term profits in commodities are treated as 60% long-term and 40% short-term. On the other hand, short-term trading profits in stocks They're treated as 100% short-term. Now, a short-term investment is one that is held for less than a year. This favorable tax treatment in commodities can translate to investors in the upper tax brackets, saving as much as 30% on taxes on short-term gains on the commodities versus stocks. Now, we always say this, and this is a mantra. Investors should always consult their tax advisors regarding their individual tax situations. But if you're in the upper brackets, you know, this may be something that would be very, very interesting for you. So I do always want to make sure you guys are aware of the tax treatment of this type of activity. Okay, so that's what I wanted to make sure you got. Now, let's say now that you've looked into everything and you've looked through the disclosure document and you see everything that everything's about, and you decide, hey, you know what? I think I'm going to proceed. I think I'm going to take part of my capital and I'm going to hire one of these advisors that I pick out, and I think I'd like to do some business. What happens next? Well, here's what happens next. Where's the money kept? The money is kept, as it shows right on your screen, in the customer segregated account at ADM Investor Services. Again, it's an established financial institution for over 50 years. How accessible are my funds in the managed account? A managed account usually offers a high degree of liquidity. Now, obviously, we're strongly advising that if you're going to hire the manager, give him time to let his strategy and program work. But you're the final decision maker on that. It's your money. So part or all of your funds can be available at any time. Okay. Now, is your money in the managed future safe? Well, your funds are kept in a segregated account in your name. So you have your own account and you have your own positions. Okay. And the CFTC regulations prohibit FCMs. In this case, it would be ADM Investor Services for commingling segregated funds. Now, you got to be advised that the segregation of the funds does not do anything about the safety of losses from the trading. It is not going to absolve you or protect you or shield you from trading losses or gains or anything else that goes on in the account. But we're only talking about the custodian aspect. Okay. Now, so you have an account, and now the question is how do I follow it? A big question. So let's see how you follow it along. You guys all have accounts out there now, pretty much. So how do you follow it now? Well, the first thing you do is you go on your computer probably, and you go to your portal, and you look at your open positions every day, which is exactly the way you can do it with this. You go to your portal, you have your own positions. This is not a pool. You have your own positions, and you can look at it. And then basically you're looking at keeping track on it on a daily basis, if you'd like, which will show you where you are right there. Now, second thing is if there is activity, you will get a activity generated statement sent to you if there's any activity. So first of all, you look through your portal every day. Secondly, you'll get a confirmation or you'll get a statement if there's activity. And then finally, at the end of the month, you're going to get your monthly statement. So there's no way that you're in the dark on this because of those three aspects alone. You have access to the information. And then, of course, you have a representative you can talk to as well. So there's great transparency here. You know, you have your own account with your own positions, with your own, your own portal, your own username and password. Okay. And then, of course, you have access to that information. And then, of course, you've got the liquidity discussion, which we already went into. So basically, again, if you would like to get more details on this, it is pretty simple to do. If you have a pen and paper handy, I am going to get you the phone number now. My name is Jim Kinney, and my phone number here is 702-873-5707. Repeating, 702-873-5707. Again, if you'd like to get more information, this type of trading, again, is not right for everyone. So if you'd like to find out if it's right for you and your circumstances, again, give me a call. There's no cost or obligation to get the details. And again, as always, I went over some historical numbers, but remember, past performance is not necessarily indicative of future results. And therefore, you have to understand that we have no idea exactly how the future will unfold. And therefore, keep that in mind. Okay, I do want to say to everyone, thank you very much for attending here today. I do get a lot of phone calls after the broadcast, so if you'd like to call right away, I would be available. But I think it might be better if you do call in and you do go to message, because we are inundated. It is a situation where it's easier for you to make one call than it is for us to make 100. So if you don't catch us tonight, you could call us tomorrow during business hours. Again, I'm Jim Kinney, phone number 702-873-5707. Until we speak again, I always wish everyone the best of luck and the best of trading. Have a good night, everybody. Thanks a lot for coming today. Let's go. You ready?